And I want to start, first of all, by getting your perspective on the change in the net open positions and how banks are playing that. It's certainly something that impacts how they deal in the FX market.
Thank you very much for having me on. It is already a known fact that recently the central bank did reduce the net open position for foreign exchange from 3% to 1%. And what that meant was that the amount of FS available to banks now for speculative purposes is now significantly reduced. The immediate reaction to the market was that the exchange rate in the interbank market suddenly went from 161 range, which it traded prior to the announcement of the policy, to 160, which signifies a positive or an improvement on what it was before. There is even more fundamental issue as far as I am concerned. What the CBN is trying to achieve really is to make sure that the pressure on the foreign reserve as a result of the speculative activities of the bank is minimized. But in my opinion, I think until the import dependency of Nigeria is addressed effectively, the pressure on the foreign exchange will continue to mount. As it is now, 80% of consumptions in Nigeria are imported from overseas, and all of these need to be funded by foreign exchange. So I think, again, like has been said, times without number, it's high time that government begin to more like look at the infrastructural deficiencies in Nigeria, strengthen the capability and capacity of banks to lend to the private sector by de-risking that sector so that they can lend effectively to that sector and increase productive activities locally rather than depending so much on foreign produce. Okay,
let's also talk about bank deposit rates, and particularly the interbank market and the deposit, the basic deposits, the term deposit that banks get from customers. The expectation generally is that that will also move higher as a result of the MPC decision. What are you seeing on the ground right now?
Yes, it's very likely, especially with the fact that the CRR was increased from 8% to 12%. That has, over time, increased the cost of fund, and as a result, we equally increase the cost of credit. Prior to the announcement, the interbank rate for local currency was in the range of 15%. But since then, it has grown to close yesterday at 16.5%.
It's a very sharp move higher there.
Sorry, say that again?
That was a very sharp move higher. You said yes. It moved up to 16% from about 6%.
That is very correct. And that is even factoring in the impact of the fact that was released into the system within the week. Otherwise, the rate probably would have gone higher than that. But that aside, looking at the impact we have on deposits and risk assets, very soon we'll begin to see banks repricing their risk assets, and even new risk assets that will be booked will equally reflect that trend, because once the cost of fund has increased, it will certainly be passed on to the borrower.
All right, and final point, the cash reserve ratio has been criticized by a few people as being the wrong move, and some suggesting that the central bank went a little too far making that move. Your thoughts on that? Many people are suggesting that more open market operations should have been the way to go, and even though that may have come at a cost to the central bank.
Yeah, there has been a divergent opinion as to the methodology with which the central bank pursue the goal they want to achieve. Withdrawing about 500 billion naira from the system using the cash reserve ratio was a cost-effective option for the central bank. And besides that, I equally believe that it does achieve immediate effect in that part of what the central bank is trying to achieve is to moderate the surging inflation, which has grown to 12.9% as at last month, with an upward risk of growing higher than that.
Right.
So by mobilizing that amount of money from the system immediately does have significant impact in moderating that down. But there is this school of thought that believe that that system does hurt the market. It believes that it has tied down so much funds with which banks would have probably advanced the credit of private sector locked up in the central bank vaults, perhaps yielding very little interest or nothing at all. So they are advocating that, look, perhaps the open market operation may have been a better option. With the open market operation, of course, we all know that that would have come with a cost. There is the cost of issuing bills and bonds
right.
in the market. So
okay.
the government probably didn't want to tread this this
okay.
route, because that would have meant the government incurring so much cost that would, at the end of the day...
Right. Kenneth, unfortunately, we really have to break now, but thank you so much. I see the point you're making about open market operations. That was Kenneth Omokhuale, strategy analyst at Diamond Bank.